If you buy real estate with cash, hard money, private money, or anything that is not a traditional bank mortgage, you need to start paying attention to what starts on March 1st, 2026, because FinCEN is turning a specific type of real estate deal into a federal reporting event. And I want to say this clearly up front so nobody mishears me. This is not they're tracking every deed that's filed. This is not every transfer gets reported. This is not your county recorder is sending your file to Washington. This is a targeted rule aimed at one thing: non-financed residential real estate transfers where the buyer is an entity or trust. Translation: this is the exact setup a lot of cash buyers use when they're trying to buy quietly and keeping their name out of the public record. So today I'm going to break it down into plain English. What transfers are covered, the biggest exceptions, who actually has to file the reports with FinCEN, what information they're collecting, and more importantly, why, what professionals are saying, what investors are saying, and the clean, boring, spirit of the law workaround. Yes, there's a workaround, and yes, it's legal. I'll show you a simple workaround that does two things at the same time. Number one, it gives the government what they're asking for, which is your name tied to a purchase. And number two, it still lets you use trusts and LLCs for protection and anonymity. Yes, from the public. But let's start with why FinCEN is collecting this information. Well, FinCEN is U.S. Treasury's financial crime unit. Their job is money laundering, people that evade sanctions, fraud, drug money, all the things you don't want running through the U.S. financial system. And for years, they've been saying the same thing. U.S. residential real estate is a great place to park money if you want to hide who you are, especially when you buy without a bank mortgage and you buy through an LLC or a trust. And yes, I'm a big fan of privacy, as you can tell from my channel. I show people how to own things so other people don't know you own things. Keeps you out of all sorts of trouble. Plus, it's none of their dang business. Now, when there's a traditional bank mortgage on a property, you have a regulated institution involved with anti-money laundering systems, identity checks, the suspicious activity reports, and all that. But when it's all cash or privately financed, there's less of that compliance. So FinCEN's goal is not complicated. They want a paper trail for the deals that historically had the least transparency and the highest likelihood for abuse. And I want to be clear, the information FinCEN collects, it is not public, just like your tax return is not public. You can still have anonymity from the public, from annoying lawyers, from ex-wives and husbands, from your tenants. The FinCEN report does not change that. You may not want to report, though, and you might be one of those Americans who feels strongly about your individual liberties. Okay, this is for you then, because you can still use land trusts and Wyoming LLCs to keep your name off title. We just have to navigate the reporting rules to avoid unnecessarily triggering them. So you need someone who understands this so you can keep your protections and your privacy. You can still get that. Now, what exactly is covered under this law that is in force on March 1st? Well, here's the basic trigger. A transfer is reportable if all of the following are true. You ready? Number one, it's residential real estate. Think single family, 1 to 4 family home, duplex, triplex, fourplex, condos, co-ops, vacant land if it's intended for building a 1 to 4 family home. It's residential real estate, not commercial, not multifamily. If it's 5 units or above, it's not. The drug lords can buy those without reporting. So it's residential real estate. Number two, non-financed. What does this mean, by the way? I want to be careful with that word because people hear non-financed and they think cash only, but it's broader than that. Non-financed generally means you did not get a loan from a financial institution that is required to have anti-money laundering programs or file suspicious activity reports. So yes, cash is going to qualify. Hard money is going to qualify. Private money is going to qualify. seller carries is going to qualify. And it depends on the facts and who the lender is. If it's a lender who already has to report, then your transaction will not need to be filed. So if your LLC finances a single family home with Wells Fargo, that transaction will not have to file with FinCEN. But if your LLC buys a single family residence with hard money from a private lender, you're going to have to file. But it won't be you filing in the report. It will be somebody in the hierarchy of closing agents, title agents, deed prep people, which I'm going to go over momentarily. Number 3, the buyer is a legal entity or trust. So LLCs, corporations, if the deed goes to an LLC, a corporation, a partnership, a trust, and it's non-financed, residential real estate, that's the zone FinCEN is focused on. Residential real estate, non-financed, closing in an entity or trust. Just keep in mind, there are exceptions, but that's the core of it. So 3 things. Small residential, no big banks, closing in an LLC or trust. That is when a filing will be triggered. So let me address the fear that everybody has. And that's really going to come down to this. Does this mean I have to file something with the government every time I buy a property? No, absolutely not. FinCEN designed this so the reporting obligation falls on the people who are already in the closing pipeline. They call it a cascade, or kind of like a hierarchy. There's only one reporting person who files per deal. And I'll give you kind of the cascade that FinCEN says to use. Number 1 is the closing or settlement agent on the closing statement. If there isn't one of those, then the person who prepares the closing statement. If there isn't one of those, then the person who records the deed. If there isn't one of those, the title insurance underwriter. If there isn't one of those, then the person who disperses the most funds. And if there isn't one of those, then the person who provides the title evaluation. If there isn't one of those, then the person who prepares the deed. And if there's nobody, then there's no filing requirement. If it's commercial, there's no filing requirement. If it's financed with the big bank, no filing requirement. If it's an individual buyer, no filing requirement. Let's go over those, because those are your exclusions. So what are they? You're using big bank. You're financed. Then you're not going to have to worry about it. If it's commercial property, then you don't have to worry about this. And if it's individual, you got it. Then you don't have to file. So that's when we're going to get back to, because that's actually a big one. If I close in my name, as long as I close, I don't have a filing requirement. So in a normal cash or private financing deal, it's going to be the title agent, the escrow company, the settlement, the closing attorney, someone like that who is actually filing with FinCEN. And here's the practical reality. Even if you're not the filer, you'll be one that's going to get the email or the request that says, hey, we need your information to complete the real estate report with FinCEN. And that leads to the next question. Exactly what information are they collecting? Well, the point of this is beneficial ownership transparency. So if the buyer is 123 Main Street Holdings, LLC, FinCEN really doesn't care about the name tag. They care about who is behind the name tag. So the reporting person is going to collect information about, hey, what's the property, what's the transaction, the entity or trust that is buying, they want that information, and the individual who owns or controls that entity or trust. So for entities, that generally means people who own more than 25% of the entity and people with substantial control. So think of the manager of the entity, executives in the entity. It's really easy. If it's like an LLC, if it's manager-managed, it's going to be that manager. Or if there's a corporation, it's going to be whoever the decision makers are. Then the same rule applies to them. who owns and controls it. So if you have an LLC that has a corporation as its manager, then they're going to look at the corporation and say, who owns it, who controls it. If it's a trust, it just generally means the people in control or who have control positions. Like think about a trustee or certain beneficiaries, depending on their rights and powers. So more than likely, the trustees and beneficiaries of a trust will be reported. For example, the reporting person must collect the date of birth, the residential address, the citizenship, and the taxpayer identification number for any beneficial owner of an entity that's the transferee, the person that's buying the property. They also care about the basics of the deal, so the purchase price, how it was paid, and the source of funds to help identify patterns. And I'm gonna go ahead and put the form that FinCEN published on their website. It's going to be a link in the show notes, so you can just go in there, or if you want to, just type form into the comments and I'll send you a link. It is basically, you can look at what the reporting person has to file so you can see exactly what information they collect. So what do other professionals think about all this? Well, I have partners that are pretty upset about it, and I have people that have vocalized all sorts of things, but they've emphasized one thing, that this is not a public record dump like you get when you probate an estate. This is what I mentioned earlier. They point out that the report goes into FinCEN's system. It's not a searchable database. This is not like a counter recorder website where you can just type in and search. That said, investors still don't like it, and I get it. It feels a lot like there's Big Brother. We're getting punished. And it's not just me, it's other investors. Most cash buyers are saying this, kind of some version of great more paperwork, which equals more expense, or great, now privacy is dead. And I don't think either of those necessarily is going to be the right conclusion. I think the better conclusion is privacy is changing lanes. If your entire privacy plan is I buy everything in an LLC or trust at closing and nobody can tie it to me, FinCEN is telling you that strategy exactly what they're looking for non-finance residential deals. It doesn't mean that you can't do it. It doesn't mean that you can't use trust. It doesn't mean you can't use LLCs. It doesn't mean that you can't protect assets. It just means that you need to structure your investments with the new law in mind to avoid it. And by the way, it doesn't always apply. There are exceptions. In fact, there's one big exception that's the cleanest way to do this while staying aligned with the purpose of the rule. And I'll get to that in a minute. But let's just go back to what other exceptions might be. Like, there's a bunch. Transfers to somebody because somebody passed away, like under a will or trust. You don't have to worry about it. Transfers resulting from divorce. You don't have to do the filing. Transfers to a bankruptcy estate. Nothing filed. Transfers supervised by court. Certain easements. There's a bunch. You can go to FinCEN and look them up, but you get the idea. That's usually where there's something else involved. There's a court, there's a bank, there's somebody else involved. They just don't want people doing stuff out there willy-nilly on their own because the bad actors have abused it in their mind. But there's one that I want you to remember because it's the one that lines up best with normal trust planning. And the exception is this: a transfer for no consideration by an individual, alone or with a spouse, to a trust where that individual or their spouse is the settlor or grantor, and that is exempt in English. If you own personally, then you transfer to a trust, like a land trust or a living trust, without consideration. The transfer is carved out, no reporting. So the exception is a trust for no consideration. I buy the property individually, and I transfer it into a trust. I know some of you guys are saying, but then your name's out there. Your name's going to be in the line of title. Yep, and makes FinCEN happy. And so this is what I want to emphasize. FinCEN's goal is transparency. So if you buy in your personal name first, your name is on that deed, it gives them what they want. And then you transfer to your trust, and that transfer is treated as lower risk because the identity link is already established. It's not like we're trying to do anything shady. Now, we use land trusts here at Anderson because they avoid transfer taxes, due on sale clauses, and allow for privacy. Heck, we can get your name off a title completely, even with this new rule. We can then assign that beneficial interest to an LLC and not have to file because it does not fall under the new rule. It doesn't get triggered. So we do meet the spirit of the rule. And this is not telling me, this is not me telling you to go out and play games with this. This is me telling you this is the cleanest, most defensible approach for a cash buyer who still wants asset protection and anonymity. They want to avoid the FinCEN filing. And so here's the basic sequence. Step one, you would acquire the property in your personal name for cash. Step two, you transfer it to your land trust where you are the grantor. You can't use an LLC. It'll trigger it, but it can be a trust for no consideration. So you transfer it to your land trust. Step three, you assign the beneficial interest to your LLC, which treats it, it's just like the property being in the LLC for asset protection. You can use a nominee, trustee, or an anonymous trustee, even on the land trust. There's no reporting, no fuss. Real estate investors generally want two things. They want asset protection and they want privacy. So the investor reaction is, how do I keep my name out of the public record? And here's my blunt answer. In most counties, if you want absolute anonymity on day one, you're going to run into friction with this new rule if you're doing non-financed purchases in an entity or trust, unless you just use this strategy that I just explained. But my name's in the chain of title. Yep. It's either buy in the name of the trust or LLC and report, or use my strategy to avoid having to report. With my strategy, your personal name purchase gives the transparency for FinCEN. They get to see what they want. And when proper trust funding gives you that protection and anonymity after you've given FinCEN what they want. Now, if you want a step-by-step walkthrough on the mechanics of putting assets into a trust, I'm going to put a link here from my longtime business partner, Clint Coons. He has a video, how to put assets into a trust. Right? Go ahead and watch that. It's a good overview. And it'll keep you from making the classic mistakes people make when they fund a trust. And here's your action step, because March 1st, 2026 is a hard date. Anything after that, if you are a cash buyer and you regularly buy in LLCs, land trusts, or other structures, you should get your buying flow cleaned up now, not at the closing table when escrow is asking for documents you never heard of, asking for information you don't want to give. Now, you want help? We'll give you help. You can book a free strategy session with my team. They'll walk you through how this works and how to minimize your disclosure, right? We'll map your acquisition flow, your trust plan, your entity plan, and your privacy goals, and we'll build it in a way that is consistent with the rule and what you actually are trying to do as an investor. Because what you do not want is the worst case scenario. You find a deal, you're ready to close, and then the closing professional says, we can't proceed until we get your beneficial ownership information, and now you're scrambling, or worse, you're tempted to do something sloppy that creates a bigger problem later. If you're a cash buyer, this is coming. March 1st, 2026. Non-financed residential property purchased in an estate or trust, those are the triggers. There's three of them: residential, non-financed, entity, or trust. If you want the cleanest approach that matches the spirit of the rule, buy in your personal name, then transfer the trust into a trust as the exception and build from there. Book the structure session and go watch Clint Coons how to put assets into a trust, and you can do it right. Good luck, guys.